Let's talk about long-term assets, specifically on asset impairments. Generally accepted accounting principle requires companies to test both their tangible and intangible long-term assets for impairment yearly. And this rule comes from the Financial Accounting Standards Board, statement number 144, Impairment of Assets to be held and used. So let's take a look. First, we need to know whether there are any events or circumstances that indicate a need to assess impairment. If the answer is no, then we do not record any impairment and the asset is reported at its carrying value. However, if the answer is yes, then we gotta go to our next decision point. We next ask, is carrying value greater than the anticipated undiscounted cash flow? If the answer is no, then there's no impairment that is necessary. However, if the answer is yes, the first question that we ask is whether there are any quoted price in active markets available as a basis for fair value determination. If there are quoted prices, then we can record the impairment loss as the excess of carrying value over the fair value. However, if the answer is no, the next question we ask is, can fair value be estimated based on market value of similar assets? If the answer is yes, then once again we can record an impairment loss. However, if the answer is no, then we're going to determine the fair value by using the discounted anticipated future cash flows. But really, what these three criteria comes down to is figure out what the fair value is, and then you can record an impairment loss. So if we were to simplify the FASB 144 standard, this is what it really says. Let's work on a couple of examples. Imagine you have a long-term asset. The carrying value on the books is $600,000. The anticipated undiscounted cash flows is $700,000, and the fair value is $400,000. So what do? First, we go to our decision point. Do events and circumstances indicate a need to assess impairment? Let's assume the answer is yes. Then we ask, is the carrying value greater than the anticipated cash flow that's undiscounted? In this example, we see that the carrying value is $600,000, but the undiscounted cash flow is $700,000. So the carrying value is less than the anticipated cash flows. So therefore, there is no impairment. Let's take a look at a second example. In this case, we have a long-term asset. The carrying value on the books is $600,000. However, the anticipated undiscounted cash flows is $500,000, and the fair value remains at $400,000. So we go to our decision tree of whether the carrying value is greater than the undiscounted cash flows. In this case, the carrying value at $600,000 is greater than the $500,000 of undiscounted cash flow. Therefore, we need to do an impairment. Next, we have to determine the fair value. The fair value given to us is $400,000. So that means we need to record an impairment loss. And that's the difference between the carrying value over the fair value. So that means we have to write down $600,000 to $400,000. The difference between carrying value and fair value is the impairment loss. As you can see, that will be $200,000. We can record the journal entry. We would debit an impairment loss, which will close into your retained earnings account, for $200,000. If the asset is a tangible asset, such as a PP&E, we would credit accumulated depreciation contra asset account for $200,000. However, if we have an intangible asset, such as a patent, then we would credit the name of the intangible asset itself for $200,000. So now you know all about the impairment of long-term assets.